Have you ever wondered if diversification is the smartest way to build wealth, or is it just a strategy to play it safe? That's the exact question we dive into with Tess Waresmith, who's been able to build her net worth to $1 million by the age of 35 by investing in the stock market and real estate. We'll explore on today's episode why diversification isn't just about spreading the risk. It's about strategically unlocking opportunities to grow your wealth one step at a time. Welcome to the InvestHER Podcast. I'm Liz Faircloth.
And I am your co-host, Andressa Gadelli.
So Tess, you've been able to build your net worth, right, from zero to over $1 million by the age of 35 as a single woman. You've done so across multiple investment vehicles, right? Why do you believe diversification is more than just playing it safe? It's actually a strategy for building wealth.
One of the main things that I've learned over the last decade plus, or almost 15 years of investing, is that life moves really fast. And in different periods of your life, different types of investing are going to be more accessible to you. And so one of the wonderful advantages I had early on was my first job out of college was working on a cruise ship. So I was able to save some money to invest. And while I was on the cruise ship, I wasn't in a place where I could learn about real estate investing, go check out markets. So that was an opportunity for me to learn a little bit more about stock market investing. And then once I transitioned to a land job, which I know sounds weird, but that's where I was at that time, I was able to get more into real estate investing. And then over the last decade, I've invested in all kinds of stuff depending on what my life looked like. So I think we get a lot of messaging that there is one specific path, and there's a lot of binary narratives around stock market investing is better or real estate investing is better. They are both phenomenal ways to build wealth. And I want more women to leverage both of them because there are going to be phases in life where real estate investing maybe isn't the most accessible to you, or you're in a place where you want to build more wealth so you can have a bigger down payment for a bigger property, whatever your goals are. So I think learning about both is so key. And I want to help more women learn about both because they're both great at different times in your life.
Yeah, I like that. There's not one size that fits all, right? And I think that is an old narrative that just needs to get stopped. Just stop talking about that because it's not true, right? Depending on the season of life. So you were in your season of life. You were on a cruise ship. How was that, by the way? First and foremost, I just need to ask about the cruise ship because that sounds like a lot of fun. If I was in my 20s. But that might have been that probably was an experience for you.
It was incredible. I graduated into a recession into 2009, so I could not find a job, and I was working at a dive bar, and I had been a competitive athlete. I was a competitive springboard diver, and so someone reached out and said, "Hey, they're looking for divers on this cruise ship for this aqua show, basically like Cirque du Soleil." I guess I would call it. So I was an aerial acrobat and high diver on the cruise ship, which is not a job I thought I would end up doing in my adult life. But it ended up being such an amazing experience. I met all kinds of people. And honestly, it was also such a great lesson in you never know who you can meet that can teach you things. Because the reason I got into investing is because I met my first serious boyfriend on the ship who was interested in it. And so we ended up diving more into real estate investing together, which was super cool. And we learned a lot, made all the mistakes, but it was great. So you just never know where you're going to meet someone that can impact your life in such a positive way. So that's actually how I got into investing, because I met a dude that said, "Hey, Tess, you can use your money to buy things that make you more money." And I thought, what a great idea. What
a concept. So you're on this cruise ship. And so walk us through when you started, investing. And I know that you made this transition from corporate to building your own portfolio and everything. But walk us through, was it a real estate purchase? Was it the stock market? Was it both at the same time? Walk us through those kind of first decisions and those first investments.
So the first couple of years, it was both. I started investing in the stock market. And when I first started, I hired someone and gave them my money to invest it, which ended up being a mistake. And we can talk a little bit about that later on. And then I also, around the same time, invested in a small single family in Tampa, Florida. And I have always been very risk aware. I am an investor, but I think there's a common misconception that investors are just willing to take on a bunch of risk. And honestly, I was afraid of losing money. So I thought I'm going to try both of these things and see which one works out and make sure I have guardrails in case something goes wrong. And Fortunately, I did have those guardrails because everything did in that first property. And so I learned a lot about how to make sure you understand the cost to repair things and really making sure you dive into inspections. And quite frankly, Liz, I also got lucky in that I didn't do my due diligence in the market. The market, that area of Tampa ended up doing well, but that was luck. So I learned a lot. And I had some luck in that first one that I was able to eventually refinance and parlay that into a couple multifamilies. And then now I've done some syndication investing as well. But it started with a very small single family, $84,000. I put $17,000 down. And then I also started investing in a Roth IRA in that year too.
I want to go back to the kind of the dual focus, right? I want to go back to that in a second, but you said something very important that I want to make a note of is so many people, especially that have done they haven't bought their first investment property or they're on their first, second, and third. And then you ask some questions about the market. And honestly, they can't answer any of those questions. Meanwhile, you ask about the property and they answer questions about the property. So I always say, that one of the biggest lessons I learned too, Tess, and I've been at this quite some time as well, 20 years, which can't see all my gray hairs. But God, I really wish someone just sat me down in my first several years and first several deals and said, Liz, put more energy into understanding the market over the property. Doesn't mean you ignore the property, but you can only, I always say you can only participate in the market. You can't change it. So that's really important that you know it like the palm of your hand so you can move quickly. What are the market rents? What's happening in the economy? Are people coming to the area? Are people leaving the area? I mean, we're talking simple stuff. And so I love that you said that. So everyone listening, please always put market over deals.
100%. I always say you can fix a house, but you can't fix a market, right?
You can't. And I tried. I mean, my husband and I early on, and I've shared this, is, we got our start in Trenton, New Jersey, right? So, for those who aren't familiar, it's the capital of the great state of New Jersey. I'm through and through a Jersey girl. And it, we thought we were going to literally change Trenton in the course of 5 to 10 years. And so because there wasn't other developers and other players in the city that were doing those types of things, and for a variety of reasons, it became tough, right? We could only have impacted streets, which we did. I'm very proud of. We renovated buildings. We renovated mixed use. We literally changed blocks in Trenton. I'm very proud of the work we did. However, we can't change the whole city, right? By ourselves. So that's something to always note. I just wanted to mention that. All right. So small single family home. Had you had to do it over again, knowing what you know now, what would you have done differently?
I would have spent more time in Tampa, wandering around the different areas. I honestly think that I got lucky, Liz, in that area, because when I went back a couple years later and I really understood, I was nervous because I thought, ooh, this market, this might not be a nice area. This area might not turn around. And so in future investments, I've always put market ahead of the actual property. And that has been such a good strategy. And so investments following that one have done really well for me. And also, quite honestly, just given me more peace of mind, right? Like when you invest in real estate, especially if you're somebody like me, that this is not your full-time job and you might have another business, or you have a job, you have kids, whatever you have going on, you want to make sure that you're choosing properties that not only obviously have the financial upside, but that also fit into your lifestyle and aren't going to keep you up at night. And that property did keep me up at night for years. And then thankfully, Tampa just exploded in all kinds of ways, but I had nothing to do with that. So looking back on that as a really valuable learning lesson, and that I got lucky, I don't plan on gambling that again. So spending more time in any market is one of the best lessons I learned really quickly.
And it's always helpful, just to give one more tip there, it's always helpful to talk to people within the community that isn't selling you something. Meaning, if you talk to the realtor, the investor-friendly realtor in Tampa, or you talk to a property manager, or you talk to a banker, they have some reason they're selling you on Tampa. I always like to say, talking to like that local city official, obviously they're selling the community as well, but they're a government official. They tend to just have data at their fingertips that people just don't speak to these people enough, like the local housing authority. These are great resources for developments that are coming into the area, things that you don't even know about and you can't even get information on by Googling. They have kind of intel because they're at the helm of people calling developers or calling them all the time. They know what's going on with infrastructure. They just have intel that no one else seems to know. And no one really talks to these people. And actually, they're great resources. So those are my go-to people. If I'm in a new market or if I'm exploring a market, I always want to find those people and ask them questions and get time on their calendar versus someone just selling me, a property, because they're trying to get commission, right? I don't know if they actually have skin in the game.
Yeah.
Okay.
And 100%. And I just want to add to even talking to people that live there that don't know anything about real estate investing, they might be able to tell you there's one market that I'm actually looking at right now. And if you Google it, it's a top market that everyone says is great to invest in. But if you talk to the people there, they will tell you that there's a lot of challenges, that there are parts of the city that are very dangerous, that are going in the wrong direction. And you can't really find that information online. So even just meeting people, asking people, hey, like, what do you think of this city? I've asked baristas that when I've gone to coffee shops, like, what do you like about the city? And I've learned a lot that way too.
That's a great suggestion, right? The people that you're not always thinking about. So you invested in a small single family home, and at the same time, you got involved in the stock market. Walk us through what you learned there, because so many women are listening, maybe have that first property or looking to buy that first property, but they're like, I'm going all in on real estate. Why would I even focus on the stock market? So walk us through your thought process and why you kind of diversified, if you will, and then what you learned in that experience.
For starters, the reason that I invested in the stock market is because I was very risk aware. I was afraid of losing money, so I wanted to put my eggs in different baskets. But I also wasn't sure how much time I was going to have investing in real estate. And so I wanted to find another way to use the money I already had and make it grow without necessarily getting another property. And so I did a lot of traveling in my 20s, and I lived in a lot of different places, and I was working on a career. And so there were times when maybe I didn't feel like I had enough money to put down on a property or to put down and make sure I had enough of a buffer in case things went wrong. So in those cases, I would put that money away in different investing vehicles. And some of them help you save on taxes. Some different types of accounts just help you grow your money with total flexibility. But there's multiple ways to invest in the stock market that can be really simple and help you build wealth on the side, maybe if you're taking some time between investments. And so that's really what I did. I always planned on getting back to real estate investing. But at the time, frankly, Liz, I just didn't have the mental bandwidth for it. I was doing other things with my life, and I knew I would get back to it. So I was thinking, I don't want to just keep this money in cash. That's just going to lose value because of inflation. So I'm going to do something smart with it. So at that point, I started investing with a financial advisor. And I did that because I thought that stock market investing was really, really challenging. I actually thought it was much more challenging than real estate investing. I thought this sounds really complicated. This is not accessible to a regular person like me. So I hired this person, and after starting to pay more attention to what they were doing, I realized that I was paying a ton of money in fees, and I was also getting pretty below average returns. And so after that, this is probably in between. Now I've done maybe 2 real estate investments at this time. I'm seeing the return of those investments be really strong and some decent cash flow. And I'm comparing that to the stock market, and I'm thinking, maybe this isn't worth my time. But what I realized is that my money wasn't invested in a thoughtful, low fee way that could get me decent returns. So after I discovered all that, I ended up learning that there are really simple ways to invest in the stock market that can be super passive, more passive than real estate investing, right? Because real estate investing does take work up front. You got to make sure you do your research, understand the market, understand the property. Once you learn the basics of stock market investing and how there are strategies you can use where you basically just invest in a big group of stocks at once and build a little bit of passive income that way, learning the basics of that takes a little bit of time, and then you can have another way to build wealth while you're still on your real estate journey. So I was really glad that I learned that lesson, that you don't need to hire an expensive financial advisor to do it for you, especially if you're investing in real estate. Like, you're somebody that wants to learn the basics. You're absolutely capable of doing that. You just need some digestible and jargon-free education. And thankfully, there are so many resources to learn how to do that now.
So walk us through, so you ended up, working with a financial planner. That did not work because the returns and just frustrated working. How long did you work with them? And then you just pulled your money out and opened up your own account? Like, walk us through what did you actually end up doing then?
Yeah. So what happened was I had invested with them for several years, for at least 5 years. And they had a majority of my money, but not all of it, because I was always very nervous about putting all of my money in one place. So I had also kept some money in cash for myself. So I decided that I wanted to make sure that that money was working for me. And so I started looking into the average return of the stock market. And this was between 2010 and 2015. So the average return of the stock market, just in case somebody's listening that doesn't know what that means, what I mean is that a group of the largest stocks in the US, what is their average return as a group? And so I was looking at those numbers, and that number between 2010 and 2015 was about 15%. And I was getting about a 6% return on the money I had invested with this financial advisor. And so once I realized that, I was candidly too nervous to just take all my money out, because I still had these limiting beliefs that I might not be capable of doing it myself. So I took some of the money that I had in cash and opened up my own Roth IRA account, which is an account that can help you save on taxes as your money grows, depending on how much money you make. So a Roth IRA is just an individual retirement account that helps you save on taxes. That's all it is. And so inside that account, you can invest in different things. So I decided to invest in one investment that held every single stock in the US. It's called a total US stock market fund. And I started very quickly beating the returns that this person was getting for me, and I was paying them. And so very quickly I realized there are easy ways to invest to get the average return of the stock market that don't require you to pay money hand over fist. And so eventually I broke up with that financial advisor, moved all my stuff over, and took control of it. But it was a process, because candidly, I was really nervous. I felt like there was some big secret about stock market investing that other people knew that I didn't. And it feels like such a black hole sometimes when we have these retirement accounts. If you're somebody that has a 401k or an IRA, it feels a bit like a mystery box. Again, it is so worth learning a little bit of the basics, because once you learn that there are vehicles where you can invest in a bunch of stocks at once, you don't have to worry about finding a needle in a haystack. You can invest consistently on autopilot, and it can be a really nice way to build wealth alongside whatever your real estate portfolio looks like.
I love that. I think something you said that I think is really, really important to highlight. This goes for any type of investment, is what is like I don't want to say the going rate, but what are the average returns that someone should expect in X? Whether you're actively investing, obviously sometimes there's infinite returns, but especially as you're growing your wealth through stocks and real estate, actively, passively, knowing what the going rate is, knowing what the going percentage, the average, return is a great place to start, because then you're able to assess, am I meeting that, or can I get that met in other ways? I mean, 15%, there's syndications, you're not getting that back. You're getting those kinds of returns, although they may promise different things, right? So I think that's a really, really good point. And I think that's our job as the kind of like the steward of our money. We need to know that's you're in the controlling seat. So once you figured that out, did you open an account and then I think you mentioned somewhere along the way that you were bullish on index funds. Is that what you put your money into? And just walk us through that a little bit, because I know a lot of women listening are probably less familiar on the stocks as much as they are in real estate.
Absolutely. So once I decided to take control of my own accounts, and it's exactly what you said, I compared the average return of the stock market, which, by the way, over time is roughly 10%. That's the average return. So that's not it every year. So if you're looking at your portfolio, you want to compare your portfolio this year to the average return of the stock market in this year. So this year, the stock market is up well over 20% at the time of this conversation. And so a lot of times people will come to me and say, oh, well, my financial advisor is making me money. It's going great. But you want to understand the actual percentage return you are getting, because in a good market, anyone can make you money. You want to make sure you're getting at least the average or more. So when I realized that my investments were vastly underperforming the average, I started to invest in index funds. So an index fund, index just means list. And so an index fund is really just a fund that holds a group of stocks that all have something in common. So one that you might have heard of is the S&P 500. You probably hear this on the news or you get this in your inbox and in one of your daily newsletters. The S&P 500 is an index. It's a list of the top 500 US stocks. And so when you hear in the news, the S&P is up or the S&P is down, what they're saying is that group of 500 as a team is doing better or doing worse. Some of those companies in that top 500 are going to do better. Others are going to do worse. But overall, this is how it's doing. And so what's great to know about that is you can actually invest in an index fund that holds all 500 of those stocks at once. So that's just one example of how you could get started investing in the stock market very quickly. This is education, not advice. I'm not telling you to go buy this specific stock, but just as an example, if you're worried about stock market investing because you're like, oh, I have to pick stocks, instead of picking a specific company, you can just buy the 500 best companies and hold them over time. And they're going to drive a majority of the returns for your portfolio anyway. So that's a great place to start. So when people realize that you can buy a variety pack of investing starts to get a lot easier. So that's just one example. There's also index funds where you can invest in every single stock in the US with just one fund. And so once I realized you could do that, I opened up an account. So I opened up a brokerage account, which is not a retirement account. There are two different types of accounts, places that you can invest in. Some of them are retirement accounts that help you save on taxes. Those are things like 401ks or IRAs. I opened up a brokerage account, which is just a regular old account that you can invest in that is taxed, but if you're getting taxed, that means you're making money. So that's a good thing. So a brokerage account you can open at any kind of brokerage like Fidelity or Vanguard are probably ones that you've heard of. And so I opened that account and I started every single month. I put a portion of the return I got from one of my properties into that brokerage account. And so over time, I was able to invest in those simple index funds. I think I had three different index funds in that portfolio. And I just automatically invested a couple $100 every single month. And it started to grow significantly over time. And then eventually I increased my contributions into that. And I actually used that money to invest in a real estate syndication years later. So that was a really cool opportunity to sort of parlay stock market investing back into real estate investing during a time when I didn't have the bandwidth or capacity to really vet deals and figure out what I wanted to do. So that's basically how I did it. So the basic steps to start investing are, one, first of all, you might already have accounts. So if you have ever worked a corporate job, you might have an old 401k hanging around somewhere. That's an investing account. That's an account that you want to make sure you have control over that is growing for you because that has stock market exposure. A lot of people don't make the connection between your 401k is an investing account. And if you don't have an investing account, if you are looking for flexibility, a brokerage account is something you can invest in. Or if you want to start preparing for retirement in multiple ways, so you might have a plan to use your real estate investment as part of your retirement, you can also invest in individual retirement accounts that can help you save on taxes too. And so inside those accounts, you can hold those things called index funds that just make investing super easy.
And how often are you looking at the returns? So you start this a brokerage account, you're managing it. And typically what's the minimum that you need to invest?
Technically, you can invest with $1.
You can invest with $1. Okay. So It's not like real estate. I'm always thinking like, minimum.
Yeah.
But because I'm more of I'm heavy into to real estate, but I've always been intrigued in the sense of growth and just, being a little more diversified in different investments. So I start with 5K, 10K, who knows, right? How often am I looking at those returns to manage that investment? How often are you looking at it? How often do you recommend people?
So for my simple investing that I'm doing into index funds, I'm barely looking at it at all. Because the type of investing you're doing, when you're investing in an index fund that holds a bunch of different stocks, your goal is to get the average return of the stock market. So you're likely not going to want to be trading that in and out, right? Over time, we know the stock market goes up. Historically, the average return of the stock market is 10%. It's been much higher than that the last few years. There's no guarantee of what it's going to do on a given year, but over time, over 5, 10, 20 years, the returns of the stock market have been very positive. And so because of that, when you're investing in these funds that hold a bunch of different stocks at once, the beautiful thing about this, and this is a difference from real estate investing, is that you don't really have to do a lot. You can invest consistently. You can actually, I have many investments that are set up just autopilot. A certain amount of money from my bank account goes into the investment, or goes into the account rather, buys more of that same index funds that holds all of those different stocks. And I just kind of leave it alone. I'm not planning on adjusting those at any time because I'm already investing in a group of stocks that's representative of the average.
That makes sense. So you have you're growing your investments there in terms of the stock side. Then you have bought a handful of properties, has certainly done a syndication. It could get overwhelming for people to say, okay, what is the next right thing for me? And so people always ask that, right? Should I put more money into, this investment, or should I go actively buy a property? Should I just passively invest, right? And in terms of, like you were saying, a syndication or lending money. What are the questions that someone listening needs to ask, whether you have a ton of investments or not? It's a constant question. It's an ongoing question we need to ask ourselves. And what do you recommend people ask themselves so they can kind of make sure they're steering the ship correctly from a diversification perspective?
The first question I would ask is, why do you want to get another property? Because if you have a specific goal in mind, then that's great. But you want to make sure that goal is still serving what you want out of life. Like, you might be at a place where you don't necessarily need to invest in another property. If you want to, and you just love real estate investing, which I do, that's great. But the first question I would ask is why? Like, what's the goal of investing in another property? And then once you've figured that out, if you've decided, yes, this is what I want to do because this aligns with the life that I want to live, and I like this lifestyle, I want to spend time pursuing this property, then the next question I would ask is, where are you at? Are you in a stable financial place to do that? Because one thing, as a financial educator now, I teach people a lot about the basics of the stock market. And oftentimes I'm talking to people that have some debt. And what I'm noticing lately is that there are more people in credit card debt that want to invest. And I want you to invest. That's great. But credit card debt is really, really sinister in the sense that you have really high interest rates that are potentially eroding the wealth that you've worked so hard to build. So if you have, for whatever reason, you have some properties or one property and you have some other things going on, like any kind of debt, you want to make sure that you're focusing on that before you continue to leverage that money into more property, because that could turn into a situation where the property you've worked so hard to get becomes at risk if you have other debt. So I think it's a matter of understanding where you are financially. If you're in a good financial place and you're excited to get another property and it's going to help you reach your goals, then I definitely think it's worth it. The other thing that I've seen a lot, Liz, is that especially in real estate investing, there's so much comparison, right? We're always comparing ourselves to other people. And I remember when I first started, I wanted to have 10 units by the time I was 32. I didn't get anywhere close to that. I had 6. And I was a little bit disappointed. But then when I looked at what I had and what it had done for my life and how it had helped me reach financial independence, I was really happy with that. So it's really important, I think, to make sure that we're thinking about what we need to live the life that we want versus chasing units because somebody else has a bunch of units. You know what I mean? It's very easy to get caught up in that. Or even when I work with people that have done stock market investing, they'll do stock market investing and say, okay, now I need to invest in real estate. Like, it's the natural next step. And for some people it is, and it's an awesome way to build wealth, but it's certainly more hands-on than passive index fund investing like we just talked about. It's a totally different ballgame. So I think understanding the why, understanding how it fits into your life, and making sure that you are in a stable financial place are things that you need to do between properties to make sure that you're headed in the track you want to go on.
Yeah, I think that's so important. And I wrote three words down as everyone's listening. You're constantly evaluating your money goals, obviously, right? Where do you want to be? Not just today, but in the next 5 years. Are your kids graduating and you're going to need to put more money aside for their college education, or you don't have kids and you just want to travel more, right? It really not dictates, but it really you want to get clear on what your money goals are today and where are your money goals in the next, several years. So you can start thinking about the future in that sense. The second thing is your time availability, right, Tess? It's like, what time do you have available? And what's going to be important for you? Because if you can passively get to your money goals, why wouldn't you do that? If you can really only get there with more active projects, if you will, then that might be what you need to do. But I like to say, what is the path of least resistance to get to your goals? And so I think we overcomplicate things. We make things a little bigger than they need to be. And it's not just more is better. I completely agree with you. And that's coming from someone who owns and manages with a group of 400 investors, a couple thousand units. More is not necessarily better. It's just different, right? It depends on what kind of business you're building and what you're looking to do. So I just want to mention that. And the third thing I hear a lot of, I don't know about you, Tess, is the purpose part. What purpose? Women want to invest with purpose. I was watching a video the other day, and there's a huge wealth transfer. I know you speak about it, and there's a huge gender gap, and something we're both very passionate about. There's an enormous amount of money women are going to be controlling, right, in the next 3 to 5 years. However, there is this level that women don't want to just invest to invest. They really want to invest in companies or projects that there's a level of purpose. So this isn't just about your next investment deal and diversify to diversify. There's more meaning there. I don't know what you think of that, Tess, but there's those three prongs. I always say it's not just about the money or time. It's also about your purpose, right? And where do you want to put your money into? What aligns with your values? These are the questions you need to be asking yourself.
100%, especially when you get to a place where you've done a few different investments and maybe you're in a more stable financial position. I'm actually in a situation right now with my first property in Tampa. I'm going to 1031 that into a new property. And right now I could list it and I could get into some type of competition and hopefully get a higher price point for it. It's in a good area. I'm actually working with the tenants to hopefully get them into a place where they can buy it. And I want to give them a fair price, and they've been there forever and they're lovely people. And so they're working on their credit, and to be able to help them become homeowners by being a little bit more flexible on my end and realizing that I'm very grateful that I've done enough investing in real estate in the stock market that I have the flexibility to not feel the urgency to do this 1031 quickly and invest in something else. And so I'm really excited about this, Liz, because they moved into this property with not a lot. They've worked really hard, and now we're in a place where they're either going to do rent to own, or hopefully we're going to give them a little bit of time to fix their credit. And that just feels amazing. And so, that's a tiny example of purpose.
I love that. And the key is to always be mindful of what's working for you now is not necessarily what you need in the future. So auditing where you are, auditing the investments that you have, even if it's just paper assets. Maybe you have some money with a financial planner. Maybe you have 1, 2, 3 properties or 80 properties, wherever you are, auditing what you have and ensuring it's giving you the return from a money, time, and purpose perspective, right? I always encourage women to do that. Audit what you already have so you can say, is this really working for me? Versus, to your point, let me go buy more properties. That may be what you need to do, but I think that's a knee-jerk reaction versus it being a very strategic decision. Yes, I need to go do this because of X, Y, Z. I'll ask women all the time why they're buying more property, and they actually don't have very good reasons.
Yeah. And I also think, and something that I love that you and Andressa talk about all the time is, if it's not maybe it is another property, but it's a totally different strategy, or you take some time to do some stock market investing and then you come back to real estate like I did, or, I pivoted from multifamilies to syndications because I was working on building a financial education business. And so that's one thing that I love about investing in general, and particularly real estate investing, is there's just so many different ways to do it. Some that are more hands-on, and the syndication will be a lower return than my other properties, but I also don't have to do anything. I think that being flexible with how you're doing things and constantly approaching things with a beginner's mindset and exploring what else is out there. You know, you guys just had a great episode on ADUs. That might be a better direction than searching for another property. It might be more in the ballpark of the finances that you're able to afford right now. So I think that we also have to be aware of it's okay to take pauses or steps back. Instead of buying a new property, maybe you can do some forced appreciation on existing property. So really taking the time and the pause to do a full evaluation, exactly what you said about what you have. And maybe there's some simpler opportunities that don't involve you trying to find another property.
Absolutely. Absolutely. And a diversification is you can really slice and dice that in so many ways. We're very diversified from a geography perspective. That makes me feel better when I'm actually diversified in different markets. That's one layer of diversification, and that's multifamily, right? So that's even in a niche. So you can really start to say, okay, what does diversification mean to me? Is it leading me towards my goals? Am I diversified enough to get to me to where I want to go? And how I want to get there with money, time, and purpose, right? I think those are the pieces of the puzzle that if you take something away, which hopefully you took a lot of nuggets away, you want to start to say, where am I today? Where do I want to go? And then what vehicle is going to help me get there with the path of least resistance? I'm a very big fan of that now in my 40s, right? I didn't think about that in my 20s, but time is not on my side, right? I'm getting older. So I'm always like, what's the path of least resistance here? So, Tess, where can everyone listening learn more about you and get connected with you further?
The best place to follow along with free stock market investing education is at Wealth With Tess on Instagram. And then I have lots of free beginner investing resources on my website at wealthwithtess.com. So be sure to head over there and you can find all kinds of stuff. If you're just getting started or you have an existing account, there's lots of free resources where you can start to learn easy ways to invest in the stock market.
Awesome. Thank you so much for being on our show, Tess.
Thank you so much, Liz.